Ding, ding, ding. It is now the top of the hour. Welcome, everybody. We are thrilled to have you here for Bruce Marshall's 14-day options income formula webinar. Tonight, you'll see exactly how Bruce targets consistent weekly gains in this unpredictable whack-a-mole market with three of his favorite low-stress options plays. Bruce is a 36-year trading veteran and former Wall Street fund manager who's outperformed the S&P by an incredible 220% this year alone. He's going to pull back the curtain on his top 3 swing trades for 2025, show you how to avoid whipsaws, and share the formula behind his 12 years of uninterrupted profitability. Let's dive in. Please welcome Mr. Bruce Marshall.
All right. Thank you, Daryl. I appreciate that. Thank you for the warm welcome. Welcome, everybody. Again, thank you for being here. Hope everybody is having a great day, great trading week. We had a wild whipsaw today, and this is kind of the point of this whole webinar session is that these markets are so unpredictable. How do you trade this stuff? So again, we're going to talk about that tonight. So glad you guys are here. Let's jump right in. And first, we have our disclaimer. Of course, trading anything is risky. Futures and options trading obviously has potential risk, potential rewards, etc. What we're going to talk about here is more from the educational side. To show you, I'm going to show you exactly what I'm doing. Of course, we can't promise any future profits and all that kind of stuff, but we are going to talk about the exact process that I follow to trade this and similar type markets. So we're going to go pretty fast. There's a lot to cover. Hold your questions to the end if you don't mind. You can write them down. We'll have time for Q&A. So with that, let's jump right in. So we all know what the market has been doing this year, and in one of the or a couple of the things that we put out, this is eerily similar to the pattern is eerily similar to COVID 2020. This is exactly what happened. I did a video, I put it on X Day and I did a video on YouTube about it. And I think the outcome is going to be the same. I think we come back down here, or we rally up here. We've come back to the previous high. I think we pull back a couple of times, maybe somewhere down here, and then we get going again, right? Lots of tailwinds, in our favor, that type thing. So I want you guys to be ready for that and don't get on the wrong side of that. And we're going to talk about, how do we trade this thing? Is this a problem or an opportunity? Because most people this year, traders, especially this first part of the year, oh, I'm getting killed. This is horrible. What do we do? And everybody goes to cash, right there at the bottom, and then they wait till about here to get back in. And that's when we start seeing momentum coming back in. But as we're going to see, that's not that's not necessary. You don't have to do that. And we're going to talk about trading on both sides of this market. So, um, what we're going to talk about tonight, what you're going to discover exactly. We're going to talk about, how to trade a wild market, how I beat the S&P by 220% year to date. It's been higher than that. It varies, of course, as we add new trades and take trades off and that type thing. But we're only halfway through the year. That's why this webinar it's so timely because we still have a lot of the year left to go. And what we want to do is to not get chewed up in the turmoil of the market, and we want to be able to be consistent. Hard to be consistent in a super volatile market because you don't know whether to get long, get short. What do we do? Is this going to black swan on us or whatever? So what we're trying to do is build confidence in any market. And the way you do that is to adapt your thought process to trade like a fund manager and not a gambler. And I say that in the nicest terms because, I've been there too. And we all want a quick return and this looks great and I'm going to do this and that and it doesn't work out. That's not the way we do it. We have to trade smarter, right? And not harder. What we're trying to do is take out the guesswork in this market, and so we can get consistent results. So I'm going to show you the actual approach to how we do that. So who am I? If you're not from Simpler, if you're new here, again, welcome. My name is Bruce Marshall. If you can see, in this picture. This is me. I think I was trying to remember before the class. I think this was 1998, I think is when that picture was taken. I still had a lot of hair. You can see the old compact laptop that weighed like 40 pounds that we were using. This is a trading team that I was on. And, this is the way it worked back in the day. Now, again, long, long time ago, I traded on the retail side, traded on the institutional side, fund manager for a long time, that type thing. In fact, when I was at several firms, they wanted me to train new fund managers. So I spent basically, most of my career training people how to trade. So, that gives me a little bit of credibility as far as what we're talking about tonight. And I actually got registered in 1989. So that's when I started, right? I managed over $150 million at that point here. And the thing about that is that that's a lot of money. 150 million is a lot of money. But in today's dollars, that's all right. But this was in 1998. That's a lot of money back then, right? So anyway, fast forward to modern times, as my kids call it, you know, um, I created Bias when I came to Simpler and started Bias in 2012, and that's Bruce's income accumulation system. I've run it for 12 years, and we've never had a down year at all. So 12 years of uninterrupted profitability in the Bias account. We're going to show a lot of bias trades. I do other trades in the main room as well. But again, my goal is simple to try to be as consistent as possible and as low stress as possible. And that's what we're going to talk about. So let's jump right in. So what's the real problem with trading in 2025? And again, I could change the 25 out to 20 because I keep mirroring the COVID market. It's cookie cutter. If you go back and look, it's cookie cutter. And the problem is markets are just too wild for static strategies, meaning, the strategies that worked last year aren't working this year, or the strategies that work this year may not work next year. So you can't be relying, depending on any one strategy. I like to buy long calls or I like to buy long puts or whatever. Well, that's great. That's a strategy, but we're looking at the tools in the toolbox to try to figure out which ones to use. Many retail traders just guess. They don't have a plan. You don't know what you're going to do when you come in the morning. Um, and it's, chasing the shiny ball around, that kind of thing. And that's not the way to do it. Or on the other end is overtrade, trade, 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 trade. That's not the way to do it either. I'm guilty of that as well. Anybody else that kind of feels like that sometimes, do the emoji thumbs up or high five or whatever. If you feel that way, and we all do, and it's part of trading because we get overzealous and we have FOMO and all that stuff. But what we need is a clear plan for managing risk and being able to adapt to quick market shifts. And that's all we've had this year is market shift, market shift, market shift, right? So it's not a strategy problem, use this trade or that trade. It's a thinking problem, honestly. So what changes everything? What can help you go from one way to the other? And again, it is a thought process. It's thinking like a fund manager, right? Not a gambler. We want structured ideas. We want planned trades. We want safety nets in place. We are not guessing. That is the main thing. We are not guessing here. We have a plan, right? So my fund manager formula is very structured, repeatable decision making process, right? And where does it start? It starts with expectations. And that might sound a little hokey, but it's really not. What I find is that most people, especially when the market gets, right here, when the market was going down, January, February, March, people's expectations were, the market was going to go zero. It's over, black swan, shut the doors, turn off the lights, all that kind of stuff. Then when it's going like this, people's expectations were, I'm going to make, 3,000% here and everything is great and buy, 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 FOMO, 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 right? And neither of those is needed, necessary, or correct, right? We need to have the same mindset here as we have here, exactly the same, right? So we have to get our expectations grounded into reality. All right, so how do we do that? Here is the fund manager formula. This is honestly the core of what we're going to talk about tonight. This is it. So we'll spend a little time on this one. The fund manager formula, number one, we'll start over here. Number one, you have to get a read on the market, right? Number one, you got to read on the overall market. What's going on? We're watching the Fed and we're watching the news and we're watching the economic calendar and all that stuff that we normally do, right? But you have to make a decision what you think the market's generally going to do. I'm not saying timing the market or anything like that. I'm just saying get a read on the market. What do you think is going on? What's going most likely to happen going forward? And what I'm talking about is, are we in a directional market? Are we in a sideways market? We're in a roller coaster market, or you just don't know. And that's okay if you don't know, you just don't know, right? Is the market moving slow or is the market moving fast? And we saw many, many times this year where the market was, we would have these huge days. The S&P is up 80 points one day and up 120 points the next day and then down 80 points the next day. Crazy stuff, right? Fast or slow. Very, very important. Most people don't even think about that, right? How do you think it's going to trade, again, in the next couple of weeks? Nobody knows where it's going to be a year from now. You can guess, but, I'm talking about the next 3 weeks, 6 weeks, maybe. That's about all you can see in a market that's moving fast. And that's what's been this year, the fast market, right? And I'm going to show you the indicators that I use and some of the things that I use as we go through here. Obviously, I don't have enough time to get into to everything, but that's, again, number one, I really want to emphasize get a good read on the market. So number two, you have to identify solid candidates. And what does that mean? First of all, we're going to eliminate the junk. There's stuff out there that just is just junk, right? Just avoid it. Most people will say when they see that, number two, identify solid candidates, they'll say, okay, Mag 7, that's what I'm going to trade. Maybe, maybe not. I love them too, but you have to trade what's working in the market, right? So it may not be Mag sevens if there is a sector rotation out of tech stocks into whatever, utilities or healthcare or banks, financials, whatever. That's where the money's going. That's where you have to trade. And big problem is people want to stick with the same thing that they're comfortable with, right? You have to trade what's working, not what you like to trade. Or, as one of my old mentors used to say, trade the market you're in and not the market you wish you were in, right? So the other thing I look at there, very important, look at volume flowing into sectors and volume flowing into stocks because you can have the best stock, greatest stock out there, best looking chart, in the world, whatever it looks like. If there's a volume coming into it, probably not going to do anything. You're not going to get this kind of growth. You might get, this kind, right? So, and I'm going to show you, or talk to you. We'll talk about ways to identify that and all that. Very, very important. Number three, once we've got a read on the market, we've identified some candidates, and maybe I will identify. I usually keep about 20 names on a list. And of those 20, honestly, I'll start with about 50. And right off the bat, I can eliminate 25 of those. I'll look at the chart. Really don't like to trade anything under the 200-day moving average for one thing. Just me. That's kind of Mark Minervini kind of thing, but or a Bill O'Neill kind of thing. But I keep, a changing and evolving list all the time, 10, 20, 30 candidates up there. So always have a basket of solid candidates, right? So then once we've got a read on the market, once we've identified some candidates, not the one stock that's going to make us rich, but a basket of stocks, right? We develop a plan, right? We have to have a plan. Now, what does that mean? We always talk about having a trading plan, right? And when we develop a trading plan, if once we have a solid candidate, right? And we like the chart and everything looks pretty good on it, right? What's our price target on the stock? Well, it's at 100. My price target's at 120. Okay, that's good. What's your time frame for it to get there? Well, I don't know. Well, that doesn't really help, right? So we have to have an idea. Maybe we look at expected moves or whatever, we'll look at fib levels or whatever we use, right? Voodoo lines, whatever. Um, how fast is the move going to happen? That type thing is as far as developing our plan. Now, the next thing, very critical, and again, we're working our way here to here to here, to here. So now we decide on a trade strategy. And when we're looking at trade strategies, we have to have the right strategy for the situation and for the market, right? And again, we're just talking about tools in the toolbox. It could be an iron condor, it could be credit spread, debit spread, butterfly, whatever. All these are just tools. One is not necessarily better than the other. We're looking for the tool that fits the situation at the time the best, based on our plan, based on our candidate, based on our read on the market, right? So in looking at that, we're looking at risk reward, how much we want to risk, what are we trying to make, that type thing. And across the board, and I will say this generally speaking, I like to risk one to make three. That's a pretty good way to think about it, right? And am I always going to risk one and make three? No, sometimes I'll risk one and make 10, and sometimes I risk one and make one, or sometimes I risk one and lose two, or whatever. But you have to have a plan, right? That's the point. One to three is what I like. And I think that's very, very reasonable, right? So then what are the vols doing? That's going to determine the strategy. Are the volatility high, meaning the VIX, meaning the volatility of your individual stock, because that will determine maybe if you want to sell some premium or if you want to buy some premium if vols are cheap, right? And what I do, we will compare and contrast ideas. And you guys at Simpler in the main room, especially, and in the bias room as well, I'll go through three or four different trade scenarios of the exact same stock. Look, and all I'm doing is looking at risk reward. Set up the same trade over and over using different things, and it's very clear if you go through that little process to say this one risk one to make three, this one risk one to make four, this one risk one to make one. Well, which one's the best? One to four is the best. Okay, probably going to go with that one. We'll keep digging a little bit deeper, right? Once we do decide on a strategy, we go to number 5. We implement the trade, we monitor the trade, and we manage the trade, right? So we have a profit target. We're going to target 20%. I'm making numbers up as we go here. 20%. We're going to target 50%, whatever. It depends on the strategy. It depends on the plan. It depends on the candidate. It depends on the market, right? This will vary, right? But we have a target. You have to have a target. Now, what happens if it goes against you? Well, I'm willing to lose 20%, or I'm willing to lose 10%, or I'm willing to lose 30%. Whatever our plan says. And again, we can work on this and dial it in a little bit closer per trade. But right now, this is the concept we're talking about, right? You have to have a stop loss limit, and it could be a percentage. And this could be a percentage. It could be a price level, right? I'm going to try to make 20 points on the stock. I don't want to lose more than 5 points on the stock. I don't want to risk more than, or I'm trying to make $2,000 on this stock. I don't want to lose more than $500 on this stock. So there are variables here. And, honestly, I kind of look at all of those as we go, because this is in flux as we go, as we're managing the trade and the expectations. Um, and we come out of the trade, profit or loss, and we continually do this every day. We read the market, identify candidates, develop our plan, decide on our strategy, implement, monitor, and manage the trade, round and round and round. That's where we go. And by doing that, we have created a plan for each trade with outcomes on both sides, right? And again, I can't go too deep here. And what in reality, what happens, and I'll show you this, is that for each one of these, we're trying to get a read on the market. Okay, well, there's a decision tree, and it goes, like this, and each one of these goes like this, and we're trying to figure out yes, no, maybe, and we end up after all this is over, we come back here with a Here's your best guess of what's going on in the market, but it's a logical process decision to get to there. Same thing here. Solid candidates, decision tree, that kind of thing. And you're eliminating a lot of things and you end up with, you know, there's your candidate, right? For the day, or your several candidates for the day. So that again, that's the core of what we're going to talk about. I'm not guessing. We're reading the environment and we're applying the right trade at the right time. That's the whole, it's the whole process. So how does that work? As we go through that, what I have seen, because I track all this stuff and I have for every year, and I track the winners, losers, of course. I track the percentages, but I also track the trade strategies. And I have been tracking this year my three best trade strategies, and they are low stress strategies because I don't want to get too deep and too complicated in a crazy market, right? We want to be slow and systematic and adapt as we go in a volatile market, right? So the three strategies, number one is the call diagonal. I really like the call diagonal. And you might be saying, I've never heard of that. I don't know what it is. Don't worry, it's not, it's very straightforward trade. The call diagonal is an amazing trade that most people don't use, and I don't really know why. I think people think it's complicated. Again, it's really not. It's like anything else. Before you learn how to ride a bike, you thought that was crazy and you could never do it, you know, but it's pretty easy if you know the simple steps of how to put it together. So why do I like the diagonal so much? You can tell I like it. It's one of, I mean, if I went back over the last this year for sure, but over the last 5 years, it's by far probably my number one winner. It works best on the SPX. I traded a lot on the SPX and we can do weekly stuff. And, again, one of the things, and I forgot to mention, is that in a market that's so wild and crazy, we want to bring in our time frame. So that's where the 14-day process comes up, is that we're not trading 6 months out because we have no idea what's going to happen 6 months from now, but we know what happens 2 weeks from now, maybe 3 weeks from now. So this is, a great trade. So why do I like it so much? It is extremely flexible. You can move the strikes around, you can move the expirations around. Very flexible. It has a great risk reward on the trade. It is, and honestly, it's very easy to scalp. It has an extremely good, I mentioned risk reward, but what I mean is this, I said I like to risk one to make three. On a diagonal at max profit, you probably risk one to make 10, something like that. It's a lot. It's a lot. Now we don't usually get that much, but somewhere in between here, 1 to 1 to 1 to 10, somewhere is, we kind of land in here. I'll show you an example here in just a second. Um, so when do I use it? If I have a solid price target, meaning I'm looking at SPX 6,500 and I have a call wall there, etc. That's a big round number. I think it's going to pin, that kind of thing. I have a fairly defined target. That's what I'm looking for. Apple, Amazon, Google, doesn't matter. I just given this as an example of SPX. So I want a fairly solid price target. If I need another reason when to use them, if I need a wider range. So if my center strike is here, I start making money here, and basically diagonal will look like this. And you have a very wide profit area, right? Very wide. Looks sort of like a butterfly, but a butterfly is more like that. It's not as wide, not near as wide out here, right? I'll talk about that in a minute. Um, on the diagonal, I do like to use this, when vols are a little bit better, but that's not as critical, right? We can get in that later, a little deeper dive. So when not to use them, and the biggest time not to use one of those is if you think you're going to overshoot the trade. And the reason is if you in a market like this, you know, If we have one of those days and you're getting kind of close to the center strike and you have a huge day and the S&P is up, 100 points or something crazy happens, and you overshoot it, you can easily close it. It's not a big deal. But if you're not sure of that upper end price target, in other words, if you had something you think is gonna could go much further, I probably would not use the call diagonal. So I'm trying to kind of get pros and cons of each one of these trades. But number one would be the call diagonal. Number two is debit spread. Debit spread has been solid trade for many, many, many years, of course. So why do I like them? Number one reason is defined risk. If you like buying calls, that's great. I do too. Buying call, a long call or a long put, either one, you have a ton of profit potential, right? Debit spread, you have capped potential, but you have capped risk. You can only lose what you paid, right? So when would I use them? If I do not have a solid price target, right? If I think whatever stock is going to go to 500, or it may go to 600. It's a crazy whatever, and it might overshoot that. And I'm just going to use a debit spread and not worry about it. And I'm going to let it run and do its thing, right? For example, on an earnings play, earnings trade, here's our earnings date. We could gap way up, we could gap way down. If we gap up, you don't want to overshoot it. Gap down, you don't want to overshoot it. You might overshoot it either way. So that's when you would use a debit spread. Very, very straightforward. One of the best trades, just simple trade, right? Again, use the strategy that fits what you think is going to happen in the time frame you think is going to happen. And then if there are some extreme cases, some of these stocks move 2, 3x what we think they might use, expected move, whatever, 2 or 3 times expected move or whatever. Then I'd use a debit spread. That way you don't have to worry about it running away on you, right? So when would I not use those? If I had a stock that I did think was going to really rip, one way or the other, and I felt pretty confident about it, I might switch to like a long call or a long put because you're kind of capping your max profit, right? That's kind of the downside of a debit spread. And you usually, I would say risk one to make three is pretty common. You could risk one to make five, depending on how you structure it. But you're capped, right? That's all you can make. But that's again, that's when I would not use it. And also the last thing on that one is if I could get a better risk reward on another trade, and I compare all these side by side. So the last one is the butterfly. You knew the butterfly would be in here. I love the butterfly trade. This is the duct tape of the trade toolbox, kind of covers every situation. Um, I like the butterfly because it probably has the best risk reward, right? Now, on a butterfly, you can risk one to make 10 all day long, depending on how far you go out in time and how you structure the width of the trade, that kind of thing. Remember, on a butterfly, a wider fly is less risk, but less profit. This is way more profit, but you're kind of threading a needle. So apply the right structure to the right trade, right? So when would I use that? If I do have a specific and solid target, like for example, I was thinking it doesn't even have to be a zero DTE, but like I think the S&P is going to pin at whatever, 6,400, 6,500, whatever. And I really think that's going to happen. Butterfly is probably the best way to go. Um, in that scenario, butterfly or call diagonal would work similarly. The butterfly would have a better risk reward ultimately. But there are reasons for that. But we don't have time to go into all that right now. I'm trying to cover a whole lot of ground here. Um, when do I use it again? I have a specific price target, and if I can hold it to the end of the trade, a butterfly works best at the end of the trade. So if you have a butterfly on for 2 weeks, you really want to hold it as close to that 2 weeks as you can, as compared to a call diagonal. You usually don't want to hold it to the bitter end like you could on a butterfly. Again, getting a little deep in the woods there or the weeds, but that's generally what I'm going for on these. And again, when not to use, if I think I'm going to overshoot, we did that with in the main room. We did I believe it's AMD trade, and we overshot it. We made money. It's a great trade, couple days, whatever. We've had three or four that we've overshot the butterflies because the market's moving very fast. And again, that's you don't know that going in, but you try to make the best decision that you can as we go. So let's take a look at some of these examples in real time, real world trades, real trades here that we've done posted at Simpler, right? So let's start with our call diagonal. And I had to put this one in there because this was a 1 day trade. We made $1,050 on it, 300% call diagonal. I just had to put that in there because it's just cool. It's fun when you can do that. We literally entered right there when we came back to that 34 MA. You see that gap? I don't know if you can see it right there. Gapped up the next day and got out of it, $1,000. Um, and you can see these numbers here. That was a bias trade that we did was posted. We all took it and all that kind of stuff. Um, so again, if you like doing those, a diagonal is a good way to do it. A call diagonal, again, we don't have enough time to get into the details here. I can absolutely go over it, and we're going to have time for Q&A, but I want to go through a bunch of these trades and show you. So that was number one is call diagonal. Number two is another call diagonal, but there is a reason that I'm showing this, right? So our 14-day plan, this one lasted 13 days. We made 30%. And you might be saying, well, that's good. That's okay, but it's not knocking my socks off. The reason that I showed this to you, we entered the trade right there. So think back, if you didn't know what was coming, you didn't know this. You didn't know this thing was going to rally. And we had done this free fall stuff for months, right? What were you doing right here? You shorting it? Waiting on this thing shorted? We went long here based on things we were looking at, right? Based on the read on the market said that we should give it a shot. What's a good way to take a shot without risking a lot of money? Call diagonal. This is on SPX again. 13 days. That was April 17th to April 30th. Again, we entered right there and we exited right there. We broke above that 34 EMA. Pretty straightforward, and it worked great. So I wanted to show you guys trades on the downside and trades on the upside just to show you this stuff works, right? So it's another call diagonal. The next one is a debit spread. Now, again, so let me go back here real quick. If you remember, S&P did that, right? Here, when the market is falling to pieces, right here, what's not falling to pieces? Healthcare. Everything shifted out of healthcare. Health money was pouring in right here, pouring in, pouring in, pouring in, pouring in. So you have to, again, you have to shift gears. And I'm not there's no real reason for me to want to trade healthcare other than the money was flowing into healthcare. The market was tanking. Do you want to be buying Nvidia and Amazon and Apple when the market's free falling? No, you want to buy things that are working, right? So on this particular trade, simple call debit spread. We're only in it for 7 days. We entered right there on that 34 EMA and we exited literally right there at the top. I didn't know this was going to happen, but we hit our profit goal and we took it and moved on our way, right? So we're constantly looking for things that are working in any market. It doesn't matter. We might trade financials, we might trade again industrials, whatever. We like to all of us like to trade tech because it's fun and all that kind of stuff, Mag 7 stuff, right? But that's not sometimes you can't always do that stuff. You have to do what's working, right? Okay, so here is another call debit spread. And again, 13 days, 146%. We entered literally right there off that. I like the 34 EMA. I'm telling you, that's my jam for my time frame, right? Now, if you're day trading futures, you're going to want a 5 and 13 or an 8 and 21, or yeah, you're going to want something shorter. I want more consistency, right? And I don't want to have to work as hard. So we entered there, 611, we exited 624, right there. And now I'm showing the most of these, almost all these are in percentages because when I post these trades, I have no idea what kind of account everybody, what size account everybody's trading. And these trades are for educational purposes only, remember. And um, so I have no idea what size account people are trading. So I will post it as, one contract or five contracts or whatever. And I'll say this is going to risk 500 to make 1500. This is going to risk 1,000 to make 3,000, whatever. You can size it up as high as you want to. You can do 100 contracts. You can do 300 contracts. It's up to you. But we have a framework to work with, and the math is the same no matter how large or how small you make the trade, right? That's why all these you see are in percentage terms. I think it's much more effective, at least, the way that we do it. All right. So again, another debit spread. The next one is a butterfly trade. Again, my top three trades for the year by far: call diagonal, debit spread, butterfly trade. Now I've got some secret sauce around all of these trades, and we'll talk about that in a minute. But it's easy. It's easy stuff, right? Butterfly trade. We entered at 34 right here. Came out here. 13 days. Do you see a pattern here? All these. I try to be in and out of these trades in about 2 weeks. Now, what will happen also? We set a trade. It's not necessarily a 14-day expiration. We may go out 3 weeks, 4 weeks, but my goal is to be out in a 14-day window, right? And again, I'm going to show you how to do that. So that was a butterfly trade. So I'm showing you these and you're going, they can't all be winners, right? Well, no, they're not all winners, of course. We're going to talk about win-loss ratio and all that. Here was a Costco. We did a Costco trade here. It was a butterfly. And what I was thinking, you see this very bullish pattern, higher highs, higher highs, higher highs, came back down here thinking higher highs would continue, kind of like this, right? Kind of like that. And what happened right here? So we entered thinking we were getting a deal there, right? And again, we could have loaded the boat. I was not sure the pattern this fall was fast, and I that made me a little nervous, but I said, if this 34 will hold, we can bounce here, and it didn't. We used one contract, literally one contract, very, very small size. I was not sure. And there is a confidence level with each trade. How good do you feel about it? And, again, if I'm max confident in a trade, that still does not mean that I oversize a trade relative to other trades. I may size it down, but I don't typically size it up too much because I'm trying to control the risk, right? So here it broke, and once it broke down there, it was just kind of over. That trade just didn't work, and we continue to fall and continue to fall. So that trade just didn't work. But this we sized it correctly. There's a lot of ways to manage trades. One is sizing correctly. The second way, this was another one. This is Trade Web here. We entered this trade here. It didn't work out, but we used time management here as a technique. And the reason that that's important, we entered here, same thing. Stock looks great, came back 34. I'm thinking this thing's going to bounce up here. And it came down here, and we're following these 34s down. Not good, not a good place to be. I thought we were kind of going into this stuff, right? But the problem was we had earnings coming up out here. And I said, you know what? We had $100 loss on this trade. And I said, let's just pull the plug on it, right? You can win, lose, or scratch, or, that's not a scratch, it's a loss, but it's not much, $100. And I said, it doesn't make sense for us to hang around in a downtrend here going into earnings. And we did have time left on the trade. We could have held through earnings. And ironically, trade reported, I think it was yesterday, and they were up eight bucks today. It's what it is. That's the way it works, right? Just it doesn't bother me one bit, right? We made the right decision, moved on. All right. A couple more here. Shop debit spread. You notice there's a variety of different stocks and different industries and all that kind of stuff. Again, this was a 12-day trade. Again, seen anything similar there? Trying to target 14 days. Simple debit spread. Bought there off 34, sold it up there off that Darvis box, piece of cake. This is a free indicator, by the way. I really like it. Uh, Walmart, debit spread, I'm trying to show. And these are simple trades. Debit spreads are all these trades are very simple trades to put together. Now, this was earlier in the year. This is 2025 when the year started. And we entered here on January 15th. I mean, Walmart's on a tear, right? Boom, 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 boom. 9 days, 87%. It's working, right? What about Scratch? You mentioned Scratch. Yes. Talon Energy. We bought this. You see this pullback here? This is kind of crazy. So when the big beautiful bill came out and all that kind of stuff, this is a nuclear infrastructure energy provider. Surely that's going to help those guys, right? And we entered right there. And guess what? Down, 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 down. And we're looking at this every day. And I'm like, man, this is the perfect stock for, you know, the market and everything, all the boxes checked. And I'm like, I cannot figure out what's going on with the stock. But obviously somebody knows something because money was flowing out of it each and every day. And we waited and waited and waited. Got all the way down here, lower 34. And I said, I'm not going to hang around for this and have it break because somebody might know something about earnings. Well, guess what was happening? You guys might know this stock. It's a great stock. Keep an eye on that. Put that one on your list, TLN. Um, there was a merger, there was an acquisition that was in process, and I guess Wall Street was not sure if it was going to go through or not. This was not public knowledge. We didn't know. But it kept going down and down and down, and I made a decision. We had to stick to the rules, right? Our rules said we're based on time frame, based on where we were. We went literally in at $1.35 and out at $1.35. 12 days. We're running out of time, right? We got earnings come up here. So guess what happened? Right after we closed it, couple days after we closed it, huge gap up. The merger went through, was up 64 points in one day, and it just keeps going up. So, that's fine. I didn't lose a second of sleep over it. It's the way it is, right? That's called trading, right? Even if we would have sold it, I don't know, here for $100 win and it gapped up, whatever, I still wouldn't, it's just what it is. That's just trading. So how does all that come together? I know we talked about a lot of examples here. I tried to show representative trades from different time frames during the year of different strategies that we have used, and again, by far the most um, number of trades that were winners were diagonals, debit spreads, and butterflies. So these are real results. These are made up of bias trades and then a lot of main room trades. So 2025, I'm at 18.42 year to date. This is in flux again. If we have a winner tomorrow, this will go up. If we have a loser, it'll go down. But we're annualizing about 36%. Again, put that in perspective. The S&P's up 6 or 547 without dividends or something like that. Anyway, so that's pretty good. And I'm not jumping up and down saying, this is the best ever. This is normal to me. I expect to be here. This is not surprising. Doesn't matter. I don't care what the market's doing. Up market, down market. I'm probably going to be somewhere around here, right? 12 years in bias, every year like this. And what this is this year, 65% win rate. We have 41 trades year to date. 7% scratch. So that 72% are either a win or a scratch. 28% loss. This is really, really in line with what I have documented and experienced for the last 30 years. I'm always in the 70% range. And again, that's not a surprise to me. I expect to be there, and I'm kind of shocked if I'm not. And again, I'm not saying this is the best thing ever. If you're trading, Bitcoin or futures or something, you're probably in a different ballpark. But what I'm talking about here is consistency, and you know, you can't live and die on a home run here or there, right? So why does this matter now? Well, obviously, markets are more volatile than ever. We are super extended right now. And I don't know if you guys saw the after hours. We're way up after hours too, based on Microsoft and Meta earnings. So everybody's like, when are we going to roll over and die? That kind of thing. We will. I don't. We're not going to roll over and die. I'm not thinking black swan, anything like that. There's still a lot of tailwind behind us, and at some point we'll have a pullback, and maybe it's a decent pullback. That will be our buying opportunity based on what we know now. We'll reevaluate day by day as we go. But if you're just guessing, that gets real expensive. I did that myself for a long time until I figured out I needed to have a plan. I need to have strategy, right? So a 14-day trade plan aims to remove the emotional decision making. It doesn't matter if the market's going up or going down. We're looking at the same criteria, and we're looking at, maybe different names to trade, but we're trying to lather, rinse, repeat and do it over and over and over. This is going to help stop you from over trading, gambling, doing the things that we all do and we shouldn't do, like lotto tickets and stuff. And I do those occasionally, but it's very, 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 they're few and far between there, and it's, very tiny size too. So I told you about the three strategies. I wanted to mention on the strategies, you may say, well, a debit spread's super simple, butterfly super simple, or go watch some YouTube videos or something. Don't do that. Um, there's a lot of junk out there on YouTube, and more every day. You guys know you get bombarded with this stuff. I was talking to my father today, and he's like, I get so many emails, every day about this and that. And um, listen to somebody that's been doing it for a while, even if it's not me, somebody else has been doing it for a while. On the trades that we do, I sprinkle in some secret sauce. Um, so there's not one way to do any kind of trade. I've done back, over the years here at Simpler, I've probably done six or eight, at least six or eight, 10 different butterfly classes on different variations of a butterfly. There's a lot of ways you can trade it. A lot of ways you can trade debit spread. Really a lot of ways you can trade diagonals, right? So I do things differently. And, you know, the one thing to do is to look at a trade and be able to figure out as best that we can, try to figure out what's going to happen before we even place the trade, right? That enables us to put parameters around the trade. What are we looking for profit wise? What are we looking for loss wise? How are we going to manage if it gets into trouble? Very, 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 very important, right? You've got to be able to think through the trade like a professional trader or a fund manager in real time for each trade. And you just lather, rinse, repeat that process, right? So that's what I want to teach you to help you make these decisions for yourself so you can structure these trades with confidence. And that's the name of the game. So my 14-day options income formula, how I make every trade decision, when and why to use each of the three strategies. Again, simple strategies, how to structure them, how to size them, how to manage to be consistent, and how to avoid the account killing mistakes that we all do. I've blown up an account or two, and I haven't in many, many decades, but along the way, I've made some dumb mistakes, just like everybody else. It's just part of it. Um, you don't know what you don't know until you step on that landmine, right? And that's unfortunate, but that's just the way it is. Unless you can have more of a structured process, right? So this is what the 14-day income formula is all about. Again, we talk about that core formula about what we do. We go through the process, and then we go through each one of the trades. So if you want to be in the upcoming class that we're doing here, the 14-day income formula, here's a breakdown of it. We're going to do the whole 9 yards, as they say, whatever, full breakdown of all of the process that we go through, exact framework, the decision tree framework, that's helped me to be profitable for so long. And again, we're not trying to time the market. We're not picking direction. We don't have FOMO. This is lather, rinse, repeat kind of thing. So that's the main class. Then we're going to have three additional breakout strategy sessions on different days. So we can deep dive into call diagonals first. We can deep dive into debit spreads, and then we can deep dive into butterflies. And in looking at this, I mean, this is a deal. It's really, really a deal because I tell you that the call diagonals strategy class alone is by itself is worth the price of admission here, right? There's a lot of information here. I hope that's coming across in what I'm saying. So again, the main class, and then we have three deep dive strategy sessions. We're going to walk through step by step. I'm going to give you everything you need, the tools you need, and all that kind of stuff. We're going to talk about indicators and most everything I use is free. I don't like to have tons and tons of indicators on my charts. Again, keep it simple, right? Tips and tricks, right? So 397, the 14-day main class, and then the three strategy sessions after that. If you are already a simpler member, you do get a discount. Be sure and put that in the discount code. I think when you if when you log in, you'll get a discount. And and I've saved some time here for some questions, but we have really good people, team members that are standing by and they can answer all your questions. These people trade, they know the lingo, you're not going to throw them a curveball on a question, that type of thing. So you can call or email, just support at Simpler Trading if you want to talk to anybody there and ask any questions. So, oh, lastly, I almost forgot. So we have interest-free payments with PayPal credit. We've been working with PayPal for a while, and I know a lot of people like that, so that's available as well. And this, honestly, this class is a lower price class. I usually do a mentorship. We were doing mentorships for a while, that would encompass this, but we would do a lot more live trading together and things like that. But we're in the $5,000-6,000 range there. This is a really, really good deal, in my opinion. So with that, let me get over to the questions and see what you guys are thinking. And let me find the questions. Give me a second here. Oh, Q&A. All right. Females, got anything? Um, Ahmed, when buying options, how many points below current price in the money one should buy, above the price one should buy? Um, Ahmed, great question. It depends. And I know that sounds kind of weird, but if you're buying in the money, you are getting a higher, and I'm assuming, let's just say the call side, you're getting a higher delta. It is a much more resilient option, less upside if you buy. So, for example, if you buy an 80 delta option, and I don't know if you're familiar with how the deltas work, but if you buy an 80 delta option, you're buying roughly 80% of the value of stock, right? Um, if you buy 30 delta, it's more aggressive, but you have a lot more bang for the buck. So it depends on the setup. It depends on the situation. Honestly, it's hard there's not a one exact answer, right? Jay, what's going on? So Jay is obviously in the main room. We did an AVGO, Broadcom Butterfly, and we closed that a little while back. We made a nice win on that one. And that's one of the ones actually that I think that kind of got to the center of the butterfly. Um, and I was afraid it might overshoot it, so we went ahead and took the win on it. I think we were only in that trade. It was the same kind of scenario. We were looking for like a 2 week kind of hold, and we ended up holding, I think, for 4 days or something like that. So it is closed. That trade is closed. So, um, so again, I hope all this makes sense. I try to keep it, very, very straightforward, very simple. The process it's really pretty simple. There are some nuances and there's twists and turns and like anything else, right? And we just don't have time to go into it in a short webinar like this. Um, but anyone can do this. Let's see. Colin, how you doing? Good to see you. Not been able to make butterfly trades work. They are great because they're cheap and define losses very small. To use fibs to arrive at the width to select. No, I use fibs in large part to arrive at the price target. right? Which would be the center of the butterfly, but what's more important is the width of the butterfly, right? Because a wider butterfly again is more stable, it's more conservative, honestly. I will use expected moves. I will use a variety of things to try to figure out how wide to make it. That's based on, you know, again, how fast the vehicle or the market's moving, what my price target is, how long it might get there. Is there, a reason that it might speed up, like earnings or run into earnings, that kind of thing. So there are a handful of things that I look at to determine the width of the butterfly. The main thing, honestly, is risk reward. So, for example, you do a 5 point wide risk reward. You might risk one to get eight, and you go 10 points wide, you risk one to make four. Well, that 1 to 4 doesn't sound as good, but you've doubled the width of it. And if you're unsure about the price, it's that trade is going to have a much higher probability of working. So again, there's a variety of things to consider there. Um, so one of the questions, can this work in today's market? Yes, exactly. I mean, that's exactly what it's designed to do, is to, adapt and adapt and adapt and adapt as we go. Because, whether you follow a plan like this or whether you have your own kind of plan, that's great, but you got to keep adapting as we go because this market is going to keep changing. And what we've seen since COVID is that the moves, these giant V-shaped sell-off and recoveries are happening much, much, much faster. If you've been around for a while, you know that that kind of recovery used to take years to do, and now we do it in months. And it's because of high frequency trading and algos and CNBC, and now everybody's on Twitter and X, and information flows very, very, very fast. So it's not going to change. It's not going to get, you know, I don't think the volatility is going to drop. If anything, probably increases. Uh, Colin, let's see, how many weeks out do you typically go for butterfly trades? Uh, typically, I will typically go out 2 to 3 weeks. And again, if I go out 3 weeks, I'm going to try to be out in two. And again, it depends. Some stocks don't even have weeklies and you have to go to the monthly. So maybe you have to go out 4 weeks and that's fine. It still work. Um, so, there are variations with you know, each and every trade based on the vehicle that we're looking at. Right. And the good thing with most of the things we trade, they're weeklies and we can really fine tune a trade to what we want to have happen. Right. Victor, what's going on? What's the average return per year? When I was in your room, you're saying 15, 20. Yeah, it's about 15 to 20. That's about average. We have some really good years and we never had a down year. But I think the worst year we were up 6 or 7 or something like that. I can't remember right off the top of my head. Um, and again, that's in a wild variety of markets over the last 12 years. And, we'll have really good years if there is say a long, steady trend in one way or the other, but we're not getting trending markets like we used to. Uh, James, how's it going? Good to see you. Will you be putting on Analyze tab instructions into the course? Yes. Yes. Well, yes. I'm glad you asked that. If you don't know, if you use Thinkorswim, Toss, I stay on the Analyze tab all the time. You can manage by the Greeks. It shows you a visual of your trade and what's happening with the trade, all that kind of stuff. Very, very, very important. You don't have to use it, but it helps. It's a big additional tool that I use all the time. So by default, we're going to be learning more and more about the Analyze tab as we go. Now, I do have an Analyze tab, very short video. It's out there on YouTube somewhere. And I'm sure that support or somebody can, or email me and I can help you with that. But yes, I will always be using the Analyze tab. Dan, so call dip spreads are out of the money. You still get a high win rate. Yes, yes. And I do. Mine are. almost always out of the money. But it depends on how far out of the money you go. Again, I'm looking at the deltas, and sometimes on a lot of stocks, you don't have dollar strike increments, right? You only have 5 point increments, sometimes 10 point increments. So you may not want to go, you may not want to move those strikes up as high as you have to, but that's the only strikes that are available. Um, but yeah, what makes the difference as far as consistency is how you manage that trade because how is it working over the time frame that you're trading, and if it's not working, you cut it loose, that kind of thing. So there's some trade management that goes along with that. Stephen, yes, yes, we will. We're gonna do a complete strategy session on spreads. Yes, absolutely. And we'll really, during those strategy sessions, it's a kind of a I don't say one-on-one, but everybody can ask as many questions as you want, and we'll just stay till we answer all the questions. And because I want everybody to walk away knowing what they're doing and, not having any doubts about it. So we'll do a deep dive there. Uh, Tall, how's it going? Experience or simple member who's in I would be in contact with my trial so class. They start to advise percent of count you're risking. I do. Yes. Yes, I do. And then, yeah, that's fine. We actually do have a trial membership to buy us, and we talk about those trades, and I will go through, this is what I'm looking at, this is why we're doing it, and this is the strategy, this is risk reward front to back, you know. I would say to people that aren't as experienced as you are, the class will kind of get you up to speed. If you're already up to speed, then you could just jump right into bias and just follow along with the trades. But yeah, I do every time we go in or out of a trade. I explain what we're doing and why we're doing it. Stella, good to see you. So again, there's not really a minimum account size. Um, it's really, really hard to say. I will, I always um, give the idea in ways to scale it down if you're not trading a large account. In other words, and I'll tell you, I mean, right now in the bias account, I mean, but when the market's moving faster, you want to move your size down, right? You don't want to risk as much because we don't know what's happening. Everything's moving around so fast. So we'll risk, I mean, $500, $1,000, maybe we risk $5,000, but we're not risking huge money. But whatever we do, you can always scale it down. If we're doing 10 contracts, you can do one. If we're doing three, you can do one or whatever. So it's very, very flexible. The math is the same, right? So I hope that makes sense. Bob, what's going on? I am not planning on being in Austin. I'm not planning on coming to the event in Austin. I've done quite a few money shows and traveled a lot this year, so I wasn't planning on coming to that one. Um, do any combos of bonds plus options? Uh, I don't. What's funny? I worked on a bond desk for a while, so I'm very familiar with bonds. And I'll trade. I do have TLT trade on, and we'll do that as a quote unquote combo. But rarely. I don't do that very much for trades that I post that might be a little deeper than a lot of people want to get into. Um, let's see. Option strat. Someone asked me about that about a week or two ago and said I should check it out. I have not checked it out, but I'm glad you mentioned that because you're the second person in like a week that's told me that. So I will check that out. Yeah, I appreciate that. I appreciate you mentioning that. Yeah, and as far as creating custom things, I do a lot of I will blend trades together. Like for example, we have a debit spread and maybe I add on a butterfly to it or something like that. Um, if this situation if we can improve the profit or if we can reduce the risk, we might do that. So hope that makes sense. All right, guys. Well, let me wind it up here. Unless anybody has any more questions, I really appreciate everybody being here. This was it's a lot of fun for me to do these. I was when I was on the fun side for a while, for a long time, I was an instructor, and I really enjoy helping people learn this stuff because it's such a great thing to do. Once you know it, right? And you can it's something you can skill you can carry with you forever. So if I can help you, let me know. And um, James, I am not sure. I'm sure if somebody sees that question, you can somebody at support can help you. I don't know where the link is. I'm on the different side than than okay, Lorna. Okay, thank you. I appreciate that. All right, guys. Well, let me wind it up here. Again, call support if you have questions on this. There are great people that. Oh, and thanks for being here. And so call support at that number or email support@simplertrading.com, and they can answer any questions. And if you wake up in the morning and think of something, call and let us know, whatever. But I'd love to see you in the class, and we will do a lot of deep dives and start putting plans together and help everybody make some money or try to make some money at least. So thanks for the time, guys. I really appreciate it. And you guys have a great rest of the evening, and I will talk to you soon. Thanks. Take care.